Hello and welcome to another technical analysis or trading tutorial. In this video, I want to talk about 3 breakout strategies or momentum trading strategies. Or in terms of technical analysis, it gives you the opportunity just to predict where the markets might be heading. So I'm going to take a look at 3 of my favorite strategies in terms of breakouts. So let's take a look at the first one. The first one I call is generally referred to as flat top breakout. Sometimes, it is also considered a ascending triangle pattern. But what it essentially is that you have a well-defined horizontal resistance level here. Yeah, so that is well-defined. It goes through here a little bit, but that is because on the daily it is very well defined. So actually here on the 4-hour chart where I'm at the moment, I would actually move it up a little bit. And then we can actually also extend it because we have another small resistance point over here. You can see that here it was resistance here. It was actually also resistance here. So we can actually extend it even further. And there you go. Then you've got your well-defined level 1, 2, 3, and 4 touch points. Just move it down a little bit in an overall. So like that. And then you have a well-defined horizontal resistance level. And what you can then see, you can see that the price action here is moving closer and closer towards that horizontal resistance level. And we've got here 1, 2, and 3 touch points. I always recommend to have at least 3 touch points. I think 3 is also the best because if you have more, it sometimes gets too obvious and it's hard to make more profitable trades, but you have 3, that's actually perfect. 3 touch points, that's a clear trend line, a valid trend line, and the price is moving slowly into the horizontal resistance line. This is also referred to as a breakout build-up structure. So what essentially happens is that at some point you'll have a reversal down here, and then the price is making higher highs and very importantly higher lows. And what we can see is that, yeah, the price is moving closer. At that point here, there was potentially a first attempted breakout rejection, but the sellers can't push the price away anymore from that resistance line, and the price is moving back in. And there is actually, if we zoom in, another small attempt by the sellers to push the price away and another higher low. And that is really a very, very clear picture and very clear prediction that, well, at least a prediction becomes possible that now we could potentially attempt the breakout and it might actually be successful. So these things should really draw your attention, really make you aware that, be prepared for a breakout. And these are like the, tipping points where something really can happen, a breakout can happen. A lot of traders can't sit on their hands. They trade before, they enter a long position before, but these are never guaranteed to work out. It is likely, but it's never guaranteed. That's how many traders can lose money if they trade beforehand, because you never know if the breakout will be successful. And generally I always wait until the breakout happens if I do trading, and I also generally wait for a retest like this one. We had something like a retest. We didn't actually go down to that level, but we had a red candle and then another green confirmation candle. And at that point, I would have entered the trade. Now, some people don't wait for a retest, and that's fine. If people don't wait for a retest, then the problem, there is more risk, because sometimes there is then essentially a retest and the retest fails, and then we go back in. It was then a fake breakout. But yeah, it all depends on your own risk levels. People who like to be a bit more on the safe side, wait for a retest, and then when that retest is successful, they enter the trade when the next green candle emerges. Now that is the first pattern, called the breakout build-up or flat top breakout structure strategy, and it's a really nice strategy to enter a trade. The next breakout strategy are flag patterns. So flag patterns are trend continuation patterns, and what essentially happens here, this is a flag pattern. So what it essentially is, it's called a flag pattern because you have something here like a flag pole, and the flag, I always, very much in the beginning of my trading journey many years ago, I did never understand, why do you call it a flag? But essentially you can clearly see that you have a flag pole and a flag itself. So that's why people call it flag pattern. So it is you have a very strong trending move, in this case to the upside, oftentimes along the moving average, and then you have at some point a small consolidation. The consolidation is weaker than the moving average, so then the move to the upside, or the move into the trend direction. And what you have here then is a very strong move to the upside, small consolidation. If we take a look at the Fibonacci retracement levels, this or such a flag pattern, the retracement should not go lower than the 0.5 Fibonacci retracement level in an ideal world. Sometimes it goes down to the 0.382, or sometimes referred to as 0.618, depending on which level you look at, but it's this one which is below the 0.5 Fibonacci retracement level. I've got them actually reversed here, and in my Fibonacci video I explain why. Normally this here is referred to as the 0.618 Fibonacci retracement level. So sometimes it goes back to that one. That's one of the main Fibonacci retracement levels. But if it goes below that, it becomes more or less likely that we continue our move to the upside. But in this case, it went to the 0.5 Fibonacci retracement level and then broke to the upside again. If you have something beautiful like this, where you're actually moving on to and touching the 20-day moving average, it could also be the 50-day moving average, it doesn't matter. But if you have something like a significant moving average and that consolidation touches that moving average, in this case where the moving average is moving up already, then it becomes more likely, and that's like one more confirming factor or indicator that makes it more likely that a breakout is going to happen. So in this case, it happened, breakout to the upside, and then when people see this breaking out at the upside, then people might enter the trade. Now in this case here, at least on the 4-hour chart, I can't see any retest. So if you were a retest trader and you would have waited for the retest, you would have missed that opportunity. Maybe there was one on the lower term time frame. And this is basically the flag pattern breakout. There's another one up here. I just wanted to show you. So if we go up, there's another one, move to the upside. It became a bit slower when we started to move into that structure, but essentially I consider that is still part of that flagpole. And then we had a small consolidation to that side here, and again moved very close to the moving average, didn't really touch the moving average, but came very close to it, and then we had the breakout. And again, can't see a retest really here, but there was a bit of a, maybe it was a retest, and again you would need to go into the lower term time frame to look into that. So sometimes what I do, I wait on a higher term time frame. I want to see these patterns building up, and then at the point of the breakout I go into the lower term time frame. So in this case maybe the 1 hour or the 30-minute chart, to wait for a good trade entry. So the last one I wanted to talk about is the fake breakout, or also referred to as false breakout. So in an uptrend here, for example, what you had essentially was, some people maybe would refer to it as a flag pattern, but it wasn't really a flag pattern. Actually what it was is we moved up, well, coming from that flag pattern, actually moved up and had something like a double top here. So one top, another top, which is a trend reversal pattern actually, because we tried to break that resistance level of 220. We failed. We gave it another attempt. It was actually a little bit of a lower high. So here, okay, it needs to come to your attention that we can't really make a new high. And here again, we tried to go up once more and made actually another lower high. So two lower highs, and then we actually broke that horizontal support level, but it was a fake breakout. So you can see that long lower shadow here, and the buying pressure was quite strong, and we pushed actually all the way up, broke through that resistance level. It became then again support, sort of retested it in a way, but this is normally where long traders then go into the trade. So when that breakout again to the upside is happening again and we get back into this channel, I talk about channel because we were trading between this one here and this resistance level here. So actually we broke back into the structure, and this is when then some traders would start or go into a long position, right? Especially because here we actually touched the 50-day moving average. So it was actually quite clear that this could be a support level, because this was on its way up and it clearly was support level. There was actually an attempt to break through, but the buying pressure was too strong, the buyer's support was too strong, and we moved all the way up. So some traders would have entered a long position here, or actually would have waited for a retest here and then entered the trade here. So would have been a really good good trade, and then they might have stayed in the trade until they've seen a potentially up until here, until they've seen that they can't make another high, really exited the trade here, waited for another breakout, re-entered here. So just an opportunity. But this is how these were basically three structures or three strategies, three breakout strategies, how you can, or traders generally, enter long positions. And again, what I always want to say is, in an uptrend I would never short. Yeah, in an uptrend I would always go long. In downtrend I would short, I wouldn't go long. The reason for that is that these, we are clearly in an uptrend here because we are above all the three main moving averages, the 20, the 50 and the 200, and trading with the moving average just ensures that the moves to the upside are just much stronger. Yeah, trading with the trend, because these moves down, they are weaker, and then moves up are much stronger. And in a downtrend it's the other way around. That is why in an uptrend I would always go long, in a downtrend always short. Okay, so hopefully that video was useful. If you liked it, please smash the like button, please comment for the algorithm, and subscribe if you haven't already done so, and if you want to see more trading or technical analysis tutorials. And yeah, hopefully I'll see you in the next video. Bye bye.